Hi, I'm Brendan Mills and welcome to episode 11 of Finance Coach TV, you and your business's finance coach. So in today's episode, we're going to look at another ratio that you can start using in your business to look at its financial health from a balance sheet perspective. And in the last episode, we looked at liabilities to equity. So what we owe in comparison to what we're entitled to. In today's episode, we're actually going to look at a similar concept, but on a different ratio. So today we're going to look at equity compared to our assets as a percentage. So in this case, we're looking at what we're entitled to compared to what we own. So it's possible for us to own a lot, but not really have much entitlement to it because of liabilities that we have. Similarly, we could have assets where we have a significant entitlement to them because we don't have that many liabilities. So if we were to liquidate our assets, as at today, how much would we actually keep of them? And this is a really important test to look at, again, the financial health of your business and where you're at. So let's go through two examples. So like what we did in the previous episode, we're going to look at a company first and then a trust and looking at their assets compared to their equity. So this company has $2 million worth of assets. And looking at the equity, it's got a share capital of $10. It's got its retained profits of $300,000. It's got its current year profits of $50,000, but it's got its related party loans owing of $150,000. So as we mentioned previously, this is money that has been taken out of the business by related parties for whatever reasons, personal, business, investment, or otherwise. Which means its equity is only $200,010 compared to assets of $2 million. So that's saying if we do our equity divided by our assets, means we've only got 10% equity to assets. So that means we're really only entitled to 10% of our assets based on our balance sheet value if we were to liquidate them. So again, we're going to look at in a moment what we consider a good, bad, or indifferent type of percentage. But just hold that thought for a moment. The next one is a trust. So we've got a trust with $600,000 worth of assets, and then its equity. $10 worth of settled sum, the formation. Current year profits, $400,000, and it's got related party loans of $50,000. So meaning that the beneficiaries of the trust, they're entitled to $50,000, but they've actually left that within the business. So that means their equity is $450,010, which means there's a 75% equity to assets ratio. So $450,010 divided by $600,000 gets you 75%. So first of all, what would you consider a poor percentage in this? If you had less than 40% of equity in comparison to assets, that's, again, you need to be wary. You're not in a good position there, or in a position you need to be really prudent with what you're doing within your business to make sure you can stay on top of your liabilities. Between 40 and 60% of equity to assets is, average. So you're not necessarily in trouble, but you're not necessarily doing, top echelon type benchmarking, but you're okay. And then once you get above 60% equity to assets, then you're in a really good space with that. So let's revisit the company quickly. So at the moment, it's only got 10% equity to assets. And you might be thinking, well, how does that happen? Well, it could happen for a variety of different reasons. For example, they might have purchased a number of assets on debt. Let's say, for example, they're in a trucking company or an earth moving company where they require a lot of assets. They may have forked out and invested in significant capital, but rather than using their own money, they've actually used bank money to fund it. Also, it could be money that's being used to run the business day to day, and it just happens to be that the assets are such that it's being funded by other people's money, so your liabilities. Conversely, with the trust, they're in a lot stronger position. So their assets of $600,000 and their equity of $450,000 says that they're a business that doesn't really rely too much on other people's liabilities to run its business. Yes, you have your tax liabilities and your employee obligations, but this is funded primarily by the owners of the business rather than outside sources. So again, that comes down to your risk appetite that we discussed in the previous episode of what you're comfortable with. But again, it's a really important metrics. Look, I wouldn't say impossible, but very close to impossible to be at 100%. You're always going to, when you're running a business, you're always going to have people that you owe money to. It's just part of doing business. But the importance is you want that percentage to be growing and growing, because that really is what you're entitled to. If you were to liquidate the assets of the business or sell the business. Now, again, business valuation is a lot more complicated than that, but it gives you a really strong understanding of what your starting point would be. So we want to build those assets, build that equity in your business. So the takeaway for today is do those calculations in your business and see where you're at. Do you need to pay down some liabilities, or are you in a strong position? Or maybe if you're actually quite a high percentage of equity to assets, maybe you want to invest more and you might be in a position to get more debt on board to fasten the growth of your business. Again, there's so many factors within that. And again, we'll be looking at that more in the future. But for today, the starting point is to understand where you're at and where you want to head, whether you need to pay down your liabilities or maybe you're in a position to actually invest in some more liabilities because of your strong equity position. So I hope you enjoyed today's episode and look forward to seeing you in the next one.